There's a funny thing that happens in personal finance. The more money you save, the more insecure you start to feel. People hit 100K, then 300K, then 500K, and the finish line never feels any closer. It's because deep down, most people have no idea how their money is supposed to pay them. They know how to save, but not how to convert savings into a paycheck. So in this video, I'm going to show you how a $500,000 portfolio can turn into steady monthly income. We'll look at the 4 layers that make it work: the main income sources, the real estate piece for stability, and the high income tools that keep cash coming in every month. I'll also show you the common traps that drain portfolios, the growth layer that protects your future, and how everything fits together into one simple strategy. And at the end, I'll show you how this setup can pay you over 37 grand a year, more than $3,000 a month, right from the start, and how giving it time can grow the monthly dividend to over 10 grand a month. But before we get into the strategy, we need to clear up one thing first, because understanding how dividends really work changes the way you see every decision that comes next. To really understand how living off dividends work, you need a mindset that's completely different from the usual high yield equals success way of thinking. When you're investing around $500,000, the goal isn't to chase the biggest number you see on a dividend screen. It's to build income you can actually depend on. Dividends aren't lottery payouts. They're more like a steady paycheck you earn because you own small pieces of real, profitable companies. And the question you should always ask isn't how much does it pay today, but will this income still support me in 5, 10, or 20 years? Think of 2 people with the same $500,000. One puts everything into the highest yielding funds they can find. On paper, it looks incredible. Double or triple digit yields, massive payouts, money hitting the account every month. But what they don't see is what's happening underneath. With a lot of ultra high yield funds, the payout isn't coming from healthy profits. It's coming from the fund slowly eating itself. The share price keeps sliding year after year, a process called NAV erosion. You'll see this pattern in funds like NVDY, ULTY, or MSTY. More on that later in the video. The yields look unreal high, double, even triple digit, but the foundation holding those yields together is melting away. After a few years, the portfolio is smaller because the stock itself loses value, the income drops with it, and the whole plan starts falling apart. The second person takes the opposite approach. They choose assets that actually grow their profits, mix in steady dividend payers, and use high income tools carefully instead of depending on them. Their income might start a little lower, but it grows, it stabilizes. It doesn't depend on a fund slowly cannibalizing its own value. And years later, they are the ones with a stronger portfolio and a paycheck that's still showing up. Another big mindset shift is understanding what real income means after taxes. Dividends from different assets are taxed differently. Some feel like getting paid in a currency that keeps more money in your pocket. Others feel like getting paid in a currency that gets taxed like a regular paycheck. If you ever plan to retire early using a taxable account, that difference can shape everything. And finally, you must accept that no single investment can do every job. Some assets are builders, some are income engines, and some exist purely for stability. When you combine them intentionally, your $500,000 becomes a system that pays you now, grows with you over time, and stays reliable no matter what the market throws at you. So, to live off dividends in a way that feels steady and predictable, you need more than one type of dividend asset. Think of your income like a house. If it sits on only one pillar, even a small shake can make everything unstable. But when you build it on multiple strong different pillars, the whole structure becomes much harder to knock down. That's exactly what the dividend ladder does. It blends 4 categories of assets that each play a unique role in keeping your income flowing both now and decades from now. The first layer is your foundation, reliable dividend growers. These are the long-term builders, the companies or ETFs designed to raise their payouts over time. They may not pay the most today, but they keep your future protected by helping your income rise alongside the cost of living, even when inflation sneaks up on you. The second layer is real estate income. This gives you a steady cash flow backed by physical properties, tenants, and long-term leases. It behaves differently from the stock market, which adds an extra layer of diversification and stability to your overall plan. The third layer is your income engine, covered call ETFs. These exist to generate strong, consistent monthly cash flow. They trade some long-term upside for immediate income, which is exactly what makes dividend living possible. And finally, the fourth layer is your growth anchor. This part of the portfolio focuses on long-term appreciation so your overall wealth doesn't fall behind inflation. When these 4 layers work together, you end up with income for today, growth for tomorrow, and a balance that protects you from relying too heavily on any single source. Now let's look at the investments that actually make this system work, starting with SCHD, because this one sets the tone for everything else. It's the kind of investment that looks almost boring at first glance, and honestly that's exactly why long-term investors love it. It's built around a simple and proven idea. Focus on financially strong US companies that not only pay dividends, but have a consistent history of doing it responsibly. SCHD tracks the Dow Jones US Dividend 100 Index, an index designed to highlight companies with healthy balance sheets, dependable cash flow, and fundamentals that make their dividends far more durable than average. Managed by Charles Schwab Investment Management and launched in 2011, it has more than a decade of real, observable performance behind it, which makes it easier to trust and easier to stick with. One of SCHD's biggest strengths is how diversified it is across the US economy. It doesn't rely on one sector or one trend. It holds companies across industrials, consumer staples, healthcare, financials, technology, energy, communication services, utilities, and more. These aren't hype stocks. They're businesses that have survived recessions, market shocks, and everything in between. When you own SCHD, you're essentially owning a portfolio of companies that know how to stay profitable through good times and bad, even when the market feels unpredictable. Another thing that makes SCHD powerful is how it selects its holdings. The index screens companies based on financial strength, things like strong cash flow, sustainable payout ratios, and healthy returns on equity. That means SCHD isn't just chasing high yields, it's prioritizing quality, which is exactly what you need when planning to rely on dividend income for decades. In a dividend strategy, SCHD is the foundation. It may not generate the highest immediate income, but it brings long-term stability, resilience, and predictable growth. 3 qualities every sustainable dividend portfolio absolutely should have. But SCHD alone isn't enough, which is why REITs play an important role. Next up, I'll show you which REIT I included in this portfolio. I'll also walk you through a couple more additions, and at the end, I'll show you how this setup can pay you over 37 grand a year, more than 3 grand a month, right from the start, and how giving it time can grow the monthly dividend to over 10 grand a month. REITs play a unique role in a dividend portfolio because they let you earn real estate income without owning or managing property yourself. Getty Realty, or GTY, is a great example of how simple and powerful this can be. Instead of dealing with tenants, repairs, or mortgages, you're investing in a company that already owns income-producing properties and leases them to businesses that pay steady, long-term rent. That rent becomes the dividend you collect, which is why REITs often deliver some of the most consistent cash flow available to investors. GTY stands out because its business model is incredibly straightforward. It focuses mainly on single-tenant commercial properties, gas stations, convenience stores, and similar everyday locations people rely on constantly. These aren't flashy businesses, but they're reliable. People need fuel, snacks, and quick stops regardless of what the broader economy is doing. That reliability leads to stable occupancy, long leases, and predictable rental income, which is exactly what income-focused investors appreciate. REIT dividends do come with one difference worth understanding. They're usually taxed as ordinary income rather than at the lower rate applied to qualified dividends. This isn't a problem, but it's something to be aware of, especially if you're planning to retire early and rely on a taxable brokerage account. In a dividend strategy, DTY fills an important middle layer. It delivers higher income than traditional dividend ETFs, more stability than ultra-high yield options, and dependable cash flow backed by real properties. Still, to make a real monthly income possible with $500,000, you need something more: covered call ETFs. Covered call ETFs are part of a dividend strategy that finally makes high monthly income feel realistic, even when you're working with far less than $1 million. These ETFs combine 2 things: a basket of stocks and an option strategy layered on top. The ETF owns shares of major companies, similar to a regular index fund, but it also sells call options on those holdings. When those options are sold, the fund collects a premium, and that premium becomes income for investors. Because this happens every month, the result is a dependable stream of cash flow that feels consistent and predictable. A simple way to picture this is to think of renting out a house you already own. You still keep the house, but someone pays you regularly to use it. Covered call ETFs work the exact same way. They rent out the right for someone to buy their shares at a certain price, and in return, they receive steady payments. The trade-off is that if the underlying stocks rise sharply, these ETFs won't capture the full upside because they've already agreed to the sale price. That's the balance: high income today in exchange for less long-term appreciation. SPYI shows this balance clearly. Managed by Neos Investment Management, SPYI holds the stocks of the S&P 500 and overlays an actively managed option strategy using both written and purchased call options. Its goal is simple: generate high monthly income in a tax-efficient way. It benchmarks itself against the S&P 500 and the CBOE S&P 500 Buy Right Index. Because so much of SPYI's income comes from option premiums, not company dividend growth, its long-term dividend growth naturally stays limited. But that's exactly how buy right strategies are built. SPYI focuses on consistency, stability, and cash flow, which is why many income-focused investors rely on it. QQQI uses the same structure but applies it to the NASDAQ 100, a group dominated by fast-moving technology companies. Tech stocks tend to swing more dramatically, and sharper swings means higher option premiums. That volatility is exactly what allows QQQI to produce even higher income potential. It was launched in 2024 and invests directly through derivatives in NASDAQ 100 companies while selling call options on the index. It isn't designed to track tech's long-term growth, instead it turns tech volatility into income. FTHI takes a slightly different approach. It is managed by First Trust and invests across a broad mix of U.S. equities and writes index-based call options on the S&P 500. Its primary goal is income, but it still leaves room for some capital appreciation. FTHI's wider diversification creates a more balanced outcome: higher income than a traditional ETF, but smoother performance than the more aggressive covered call funds. This makes it a useful middle layer in a dividend strategy because it helps stabilize the swings that come from more concentrated options-based funds. But taxes are another important factor with covered call ETFs. Many distributions are taxed as ordinary income instead of qualified dividends, meaning they may face higher tax rates depending on your bracket. For early retirees using taxable accounts, this difference matters because it affects how much income you actually keep. It doesn't make covered call ETFs less valuable, it just means you need to understand the tax treatment so you can plan around it. Return on capital, or ROC, is another term that shows up often with covered call ETFs, and it's much simpler than it sounds. ROC lowers your cost basis instead of counting as taxable income, which means it reduces your tax bill today, but it can increase the amount you owe later when you eventually sell. Suppose you invest $10,000 into a covered call ETF. At the end of the year, it pays you a $500 distribution, and the fund reports that $300 of it is ROC. That $300 isn't taxed at all right now, which feels great, but it lowers your cost basis from $10,000 to $9,700. Nothing bad happens immediately. The catch shows up years later if you decide to sell. If your investment has grown to $12,000, your taxable gain isn't $2,000 anymore, it's $2,300, because the ROC lowered your original cost basis. So ROC isn't good or bad on its own, it simply shifts part of your tax burden from today into the future. Covered call ETFs also have natural limitations. Because they sell away upside, they tend to lag behind traditional ETFs in a strong bull market. Their payouts don't compound the way dividend growth stocks do because much of the income comes from option premiums, not business expansion. And many covered call ETFs are still relatively new, meaning they haven't been tested across several decades of market cycles. Even with these limitations, covered call ETFs fill a crucial role in making dividend living possible with a $500,000 investment. They turn everyday market movement, whether calm, choppy, or volatile, into consistent, reliable monthly cash flow. But before we move on, there's something you absolutely need to watch out for because not all high-income funds are your friend. Some of them look incredible from a distance, but once you get close, that's where the real danger starts. Ultra-high-yield funds are the biggest trap in the income world. They flash numbers like 50%, 80%, even triple-digit yields, and it feels like you've just found a cheat code to passive income. But those giant payouts come with a cost most people don't see at first glance. The fund's NAV is melting underneath the surface, and once the NAV erodes, the income dries up with it. The clearest way to see NAV erosion is to look at it with simple numbers. Suppose you invest 10 grand into an ultra-high-yield fund. It pays you an eye-catching 50% yield, so you receive 5 grand in distributions that year. It sounds incredible, until you check the NAV and see the fund's value has dropped from $10,000 to $6,000. You didn't actually earn 5 grand. The fund paid you mostly by selling off its own assets, which is why your investment shrank by $4,000. The income looked huge, but the foundation underneath it collapsed. And if that pattern repeats, eventually there's nothing left to pay you anything. The Yield Max lineup is the best example of this problem. Funds like MSTY, NVDY, and ULTY show triple-digit trailing yields that look unbelievable at first glance. But those payouts come with shocking NAV destruction. ULTY has seen deep declines, NVDY continues to bleed value, and MSTY has experienced some of the most dramatic drops of all. It doesn't matter how high the dividend is if the investment underneath loses 30, 40, or 50% of its value in a single year. You're just getting your own capital returned in a way that looks like income. On top of that, these funds charge high fees and haven't been around long enough to prove they can survive a full market cycle. There's no dependable history, no stability, no long-term track record. Avoiding them isn't about being conservative, it's about protecting the wealth you've worked so hard to build. And that brings us to the part of the portfolio built for exactly that kind of protection. If you want a foundation that stays strong through decades of market ups and downs, you need an anchor that grows steadily and doesn't crumble when things get rough. SPY fills that role perfectly. SPY is an ETF that's been around since 1993, which already tells you a lot. It's one of the oldest and most trusted funds in the world. It tracks the S&P 500 using full replication, which basically means it owns the same companies in the same proportions as the actual index. No shortcuts, no exotic strategies, just straight exposure to the biggest and strongest companies in the US. And that matters because the businesses inside the S&P 500 are giants across every part of the economy: tech, healthcare, consumer goods, financials, energy, industrials, you name it. These companies tend to grow over long periods of time, even if they hit bumps along the way. That steady growth is something dividend investors sometimes forget about when they get too focused on yield, but it's the part that keeps your overall wealth from falling behind inflation. So think of SPY as the growth engine of your dividend strategy. Covered call ETFs give you income today, REITs provide steady cash flow, SCHD grows dividends, but SPY is what keeps your overall wealth rising so your future lifestyle stays protected as prices climb. When you combine all these pieces, you get a balanced portfolio built for income and growth. Now that each category makes sense on its own, this is where everything comes together into one balanced strategy. With $500,000, the goal isn't to chase the highest yield, it's to blend assets that pay you now, grow your income over time, and protect your long-term future. This hybrid portfolio does exactly that using SCHD, GTY, SPYI, QQQI, FTHI, and SPY in a structure where each position supports the others. SCHD leads with 30%, offering a 3.75% yield, 10.43% dividend growth CAGR, and 7.82% appreciation. This becomes the long-term durability layer. GTY sits at 15%, adding real estate-backed stability with a 6.84% yield, 7.64% dividend growth, and 5.08% appreciation. Next come the income engines, your covered call ETFs. SPYI with 20% weight delivers an 11.64% yield, 2.5% dividend growth rate, and 3.18% appreciation. QQQI with 15% weight follows with a 13.64% yield and 3.09% appreciation, while FTHI with 10% weight adds an 8.67% yield, 7.39% dividend growth, and 1.61% appreciation. Finally, SPY with 10% weight brings a 1.08% yield, 5.8% dividend growth, and powerful 12.73% annual appreciation, protecting your buying power for decades. And with the full portfolio in place, here's what it actually produces after 1 year. Now that you understand the structure of the portfolio, let's look at how it actually performs after 1 full year. SPYI delivers high monthly income totaling $11,640 per year, which comes out to about $970 per month, while still finishing the year at $114,820. QQQI adds $10,230 annually, roughly $853 monthly, ending with a new balance of $87,548. These two alone create a powerful and steady income base from covered call premiums. FTHI brings in $4,335 per year, close to $361 per month, ending the year at $55,140. SCHD contributes $5,625 annually, or around $469 monthly, with a closing balance of $167,355, showing how dividend growth and appreciation work together. GTY provides $5,130 each year, about $428 monthly, and finishes at $83,940, powered by long-term real estate leases. And even though SPY isn't built for yield, it still produces $540 annually, around $45 per month, while still rising to $56,905. Altogether, the portfolio generates $37,500 in annual income, which breaks down to $3,125 every month. And despite paying out all that income, the total portfolio value still rises to $565,708.
That's just the first year. But the real question is, what happens when you keep this system running for 5 or 10 years and reinvest those dividends? First, let's look at how it performs after 5 full years. SPYI leads the income side, generating $19,606 in year 5, about $1,633 per month, while the position grows to $198,203. QQQI follows with $16,399 annually, roughly $1,366 per month, ending at $156,924. FTHI adds $8,257 per year, around $688 monthly, and finishes at $85,548. SCHD contributes $9,714 annually, about $809 per month, and grows to $261,658. GTY produces $8,991 per year, or $749 monthly, reaching $133,830. SPY, despite being the lowest yielding position, still generates $677 annually, about $56 per month, while compounding to $94,887. Altogether, the portfolio generates $63,644 in annual income, or $5,303 per month, while growing to $930,050 by year 5. Now let's look at how this portfolio performs after 10 full years, and this is where the hybrid strategy really starts to show its long-term power. SPYI remains the top income generator, delivering $37,052 in year 10, about $3,087 per month, while its position grows to $386,292. QQQI produces $27,465 annually, roughly $2,288 per month, ending the decade at $302,798. FTHI brings in $20,863 per year, close to $1,738 monthly, and finishes at $168,318. SCHD contributes $19,647 annually, about $1,637 per month, while its value reaches $467,631. GTY produces $18,834 per year, around $1,569 per month, ending at $249,300. SPY still delivers the lowest income, $888 annually, or about $74 per month, but grows to $177,834. Altogether, the portfolio generates $124,749 in annual income by year 10, about $10,395 per month, while the total value climbs to $1,751,173. The result is a portfolio that pays significantly more over time, grows aggressively underneath, and stays structurally strong through both income cycles and market cycles. If you want to see how to build over $6,000 a month in dividend income while still only investing about $25 a week, click the video on your screen. It'll walk you through the whole step-by-step plan.